Good morning and welcome to another edition of Bourdier's Monday Report. The economic statistics published in the United States last week were, on the whole, mixed. With the arrival of the trade war, some of them have been disrupted, such as GDP growth in Q1. Overall activity contracted by 0.3% compared with the last quarter of 2024. However, this is not a sign of weak domestic demand. In fact, this contraction can be explained by the very strong increase in imports, which were made in anticipation of the tariffs and which had a negative impact on growth. Domestic demand grew by 3% over the quarter, thanks to strong household consumption and business investment. Even more than economic fundamentals, market trends continue to be dictated by the flow of news about the trade war. China's willingness to open negotiations in the trade war with the US has boosted risk appetite. Equities, also supported by satisfactory first-quarter earnings reports, posted significant gains of around 3% in the major markets. 10-year government bond yields rose by a few basis points, pushing prices down by 0.3 to 0.4%. Gold suffered slightly from this renewed risk appetite, falling 0.3%, in line with the dollar's 0.6% appreciation. Finally, oil prices fell by 8.4% over the week, a sign that the outlook for growth remains uncertain. In addition, OPEC has announced this weekend a further increase in production for June. This will have a downward impact on prices and on overall inflation. This week in the US, we have the release of the ISM Services Index and the meeting of the Federal Reserve, which is expected to leave its key interest rates unchanged. In China, our attention will be focused on the release of inflation figures. In the technology sector, our favorite stock among the Max 7 is Microsoft. The company has published better than expected first-quarter figures, and the fact that it is less exposed to the trade war dispute reinforces our choice. That's all for today. Thank you for your attention and see you next week.